Did you know that your crypto assets might soon be caught in a financial trap you never saw coming? Imagine waking up in 2026 only to find that a wave of new measures has turned your crypto investments into potential tax liabilities. Today, we dive deep into the UK's new crypto tax compliance crackdown and uncover what it means for you. The UK government is gearing up to enforce the crypto asset reporting framework in a groundbreaking way. Not only will this framework target cross-border transactions, but it will also apply to every UK resident holding crypto assets. This shift marks a significant tightening of the regulatory net, and if you're invested in digital currencies, it's something you cannot afford to ignore. So, why is 2026 such a milestone year for crypto investors? The truth is, the UK is stepping up its tax compliance game to root out evasion and ensure transparency. This ambitious plan comes on the heels of global efforts to crack down on cryptocurrency tax fraud, and while it promises a fairer system overall, it introduces a new layer of complexity for investors. In a world where crypto was once seen as the Wild West of finance, tighter controls mean that some investors might face worst-case scenarios if they're not prepared. Let's unpack this further. The crypto asset reporting framework is built on the idea that every transaction should be visible to tax authorities. Traditionally, this has been applied for international cases, but the UK's decision to bring UK residents under its ambit represents a notable expansion. Thousands of self-managed crypto portfolios that were previously under the radar might soon come under scrutiny. This isn't just about catching the big players, it's a reset of the playing field, impacting everyone from seasoned traders to casual investors. You might wonder, is this just another bureaucratic overreach, or is there a method to this madness? In a way, it's both. On one hand, the policy is designed to plug loopholes and create a level playing field. On the other, it introduces new challenges, particularly for those who haven't kept meticulous records of their transactions. Imagine trying to reconstruct years of trading history from disparate platforms. It's a daunting task, but here's the silver lining. Understanding these measures now can help you avoid costly pitfalls later. Let's set aside the fear factor for a moment and look at the practical side of things. The UK government's move is aimed at making sure everyone pays their fair share of taxes on crypto gains, regardless of how they trade or hold their assets. For many, this means revamping their record keeping, rethinking portfolio strategies, and perhaps even engaging with financial professionals who can help untangle new compliance requirements. If you've been casual about your crypto, or even if you're a seasoned player, you now have to ask yourself, have I been prepared for this kind of regulatory overhaul? Consider the worst case scenario, years of unmanaged or poorly documented trades coming under review. Data, mismatches, incomplete records, and an intricate web of cross-border transactions can create red flags for tax authorities. The potential consequences range from hefty fines to a full-blown audit, which could disrupt not only your financial planning, but also your overall wealth strategy. Now, if you fall into that camp, the good news is that there are steps you can take to avoid these issues. One immediate takeaway is the importance of robust record keeping. If you haven't already, start consolidating all your crypto transaction records from every exchange and wallet. Think of it as building a financial diary that tracks every move you make in the crypto space. Not only will this help you provide accurate answers to any regulatory inquiries, but it may also prevent those troublesome surprises during tax season in 2026. In the end, the effort you put in today could save you from a financial headache tomorrow. Let's shift gears and talk about another aspect that many investors might undervalue: professional advice. Now, I'm not saying you need to hire a tax attorney or a crypto accountant overnight, but a quick consultation could be a game changer. There's a myth floating around that as long as you're investing in crypto, you're on the fringe of conventional finance and can bypass all regulations. That's simply not true. The moment your portfolio starts generating significant returns, the regulatory radar is bound to catch up. Getting ahead means aligning your investment strategies with the evolving legal landscape. Imagine having a proactive discussion with a financial professional who understands both the intricacies of digital assets and conventional investment tax law. They could help you structure your trades, advise on the best software for record keeping, and even suggest strategies to legally minimize your tax burden. This isn't just about compliance, it's about smart wealth management in an increasingly complex environment. One of the most interesting and controversial aspects of these new measures is the notion that increased transparency could lead to unintended market behavior. Could tighter regulation cause investors to move funds offshore or seek alternative less regulated investment vehicles? The financial world is buzzing with these questions, and while the answer is still unfolding, it's something every investor should consider. Now, let's briefly delve into what these new measures mean by comparing them to past changes in tax policy. Historically, when governments tighten control over certain financial sectors, the initial adjustment might seem painful. Remember the scramble during the crackdown on offshore bank accounts? Many investors had to quickly adapt, reevaluate their holdings, and adjust their financial planning strategies. Similarly, in the crypto world, those who prepare now will be in a better position when 2026 rolls around. There's also another angle to consider: the rise of reporting software and technology solutions designed to help track crypto transactions. Imagine using a tool that automatically consolidates data from multiple exchanges, categorizes transactions, and even flags potential red flags before you file your taxes. These tech solutions can turn a daunting record-keeping task into a manageable, even seamless process. For many, investing in such technology could be the difference between staying compliant and facing long audits or fines. What about the global implications? While today we focus on the UK, regulatory trends are converging internationally. In many parts of the world, finance regulators are working together to share data on crypto transactions. This coordinated approach means that even if you're based in the UK, your transactions might be scrutinized in conjunction with overseas data. The entire financial ecosystem is becoming more integrated, and digital assets are no longer isolated from broader tax compliance efforts. So you might well ask yourself, how prepared is my entire financial portfolio for global regulatory cooperation? At its core, what does this mean for you? Whether you're casually investing in Bitcoin or actively trading a diverse range of digital assets, the rule of thumb is clear: know your records and understand your obligations. The shift is designed to catch those who try to hide gains or obscure transactions. But for disciplined investors who have maintained clear, detailed records, this transition might actually enhance trust and confidence in the crypto market. Before we wrap up, let's revisit the broader picture. The 2026 crypto tax measures mark a pivotal moment in the intersection of technology, finance, and regulation. This isn't merely about transferring data to tax authorities, it's about reshaping how we view digital assets in the context of modern financial systems. For you, it's a wake-up call to review your financial habits, fine-tune your investment strategies, and perhaps even rethink how you manage wealth in a digital age. I learned the hard way that ignoring changes in the regulatory landscape can lead to expensive mistakes. Now, my takeaway for you is simple: prepare now and use these changes as an opportunity to refine your approach to crypto investments. Whether you're a seasoned trader or just starting, a few proactive steps like enhancing record keeping, seeking professional advice, and investing in technology can help you navigate the choppy waters ahead. In a nutshell, the upcoming enforcement measures are not just a regulatory straitjacket. They're a chance to level the playing field, protect honest investors, and push the financial industry toward greater transparency. As you review your portfolio and consult with advisors, keep a lookout for reliable, fact-based information rather than sensational headlines. It's the details that matter. So here's the actionable insight. Start today by inventorying your crypto investments. Dig into your transaction history and make sure each entry is accurate. Look for software solutions that can streamline this process. And finally, have a candid conversation with a trusted financial professional about the upcoming changes. The aim is not just to avoid penalties, but to build a resilient strategy that stands up to changing regulations. Remember, this is general information, not personalized tax advice, and they help UK professionals avoid financial traps and make smarter wealth decisions. And what I'm telling you today is grounded in that same mission. By understanding these new measures, you empower yourself to not only comply with regulations, but to thrive in a more transparent, accountable financial ecosystem. At the end of the day, the choice is yours. Will you let uncertainty and fear dictate your financial strategy, or will you use this moment as an opportunity to sharpen your game? The road ahead might be challenging, but with careful planning and the right mindset, you can transform potential pitfalls into stepping stones for greater financial success. Now that you know what's coming, it's time to act. Reevaluate your portfolio, consult trusted professionals, and embrace the future of digital asset regulation head on. Don't let these changes catch you off guard. Be proactive instead of reactive. As we move closer to 2026, staying informed and prepared will be your best defense in the evolving world of crypto finance.